Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.
Paris Milling Wheat. In November last year, the market broke down and out of the combination of the descending triangle, highlighted in bright red on my daily chart, and that's currently 231 to 233, as well as a break below the neckline, highlighted in purple on my daily chart, currently 234, of the June to November 2023 head and shoulders top. This was a break all the way down to the May 2023 low at 221, before a reactionary rejection back up. However, the reactionary move back up only managed to reach the area of the neckline and the lower trend line in mid-December, but then failed again, dropping down to the May 2023 low 2 weeks ago and breaking below it. In this process, the market filled in a previous gap left over from when the market originally moved up back in July 2021, between 218.5 and 219.5. Now, for the descending triangle, I had laid out some targets below some 5 weeks ago. Thus, the primary target was in the 227 zone, whilst the harder to reach secondary target X1 was in the 220 zone, just under the May 2023 low. 2 weeks ago, the secondary target X1 in the 220 zone was achieved. As for the larger head and shoulders top pattern, well, I had been frank 5 weeks ago in stating, and I quote, that I am not necessarily comfortable with the head and shoulders pattern, but I still feel obliged to indicate potentials for this pattern below. Thus, a primary target X2 is in the 215 zone, with a secondary harder to reach target X3 down below the bottom of my daily chart in the 198 and 197 zone. And that's the end of the quote. At this time, we are actually within spitting distance of achieving the primary target X2. What we are seeing now is the market overcoming the 50% absolute Fibonacci line at 218.75. The next significant support is the March 2020 to date uptrend, currently at 215.5. But I suspect we may drop down to the July 2021 low at 211.25. So, as part of this move lower, I would like to once again discuss a previously mentioned big picture item. Now, the market is still well within the big bear channel, currently at 241.75 to well off the bottom of my daily chart. This bear channel is highlighted in dark blue on my daily chart and originates from June and October 2020. Coming up to 2 years old now. It is right and appropriate to consider the big picture item in the light of what has been recently seen. Minneapolis wheat. Now, compared to Chicago wheat and Kansas City wheat, Minneapolis wheat had usually been somewhat easier to read in the past, with respect to what was going on and what the opportunities might be. For a while, this seemed no longer to be true, but recent actions seem to have brought the market back into a clearer line. So, going back to late February 2023, and especially at the start of April last year, so it's just outside the parameters of my daily chart, the market constructed a large bear channel that morphed into what we now see highlighted in dark blue on my daily chart. A descending, expanding wedge pattern, currently 777 down to well off the bottom of my daily chart. The relevant portion of this pattern actually originated from December 2022, but only really became evident from February 2023. The upper trend line has been escorted and reinforced in the past, sort of, by the declining medium moving average, currently at 740, which when combined together help cap the market back late last year in very early April, then mid-April, mid-May and mid to late June. However, in mid-July, the attempts higher resulted in a clear break above the upper trend line, and also the important declining long moving average, currently at 788. Prices climbed rapidly during July, up to the 50% Fibonacci line of the significant August 2020 to May 2022 move at 955, where the rally petered out and turned back down. It is this turn back down that's captured my attention, as the market had, since late July till mid-September last year, formed a descending scallop pattern. Not only that, but since mid-September 2023, the market formed the crucial ski jump of this descending scallop pattern. And from the start of October last year, it started on its subsequent journey lower to potential targets below for such a pattern. Thus, a primary target for such a pattern was in the 708 zone, with a secondary harder to reach target X1 down in the 689 zone. 8 weeks ago, the market punched down through the recent 737 to 724 congestion zone, down into the next congestion zone below between 693 to 708, thus reaching the primary target. Now, finding itself overextended, prices reverted back up, currently to 724, highlighted in green on my daily chart. Throughout December 2023 and into January 2024, in truth, this moving average had been an effective cap on the market since mid-October. Not tested, but effective nevertheless. At the end of last year, prices gave up testing the overhead short-medium moving average and headed lower. By the middle of last week, the market had reached target X1, the harder to reach secondary target for the descending scallop pattern, and immediately reverted back up, though not as far as the declining short-medium moving average. And we've seen since this lack of bullish pressure run out today, with prices once again heading lower. We are now heading once again down into the previously mentioned congestion below between 693 to 708. 5 weeks ago, I put forward the following question. The idea out there, and I quote, "The question remains of whether the move lower is still genuine or not." I suppose the move higher is also debated each time prices reach the short-medium moving average overhead. But now I'd like to highlight again a new pattern, one that I spotted 7 weeks ago, so that is now actually 12 weeks ago. It is the nascent August to date bear channel, highlighted in bright red on my daily chart, and that's currently 625 to 738. This pattern is still operational, and once again I note how we have a smaller bear pattern nestled in a much larger one, much like a Russian doll. End of quote. This pattern is still operational, and once again I note how we have a smaller bear pattern. This pattern is still alive, though we've not really had any tests below or above. Until something else gives, this pattern will be the one to watch. London UK feed wheat. The move higher from the May to July 2023 double bottom pattern reached its climax in mid to late July last year, with a combination of an island top that was also part of a small double top Adam and Eve type. Since then, prices moved lower and eventually sideways, and most recently lower again. The short-medium moving average, currently 183.45, has tried, not wholly successfully, to act as a sort of a cap on any rises. And the medium moving average, currently 185.15, has moved away from being a market attractor to being a slightly distant cap on any recent attempts higher. Interestingly, one of the key features here, and it is a surprising feature, has been the neckline, highlighted in dark blue on my daily chart. Now it's currently at 187 even. And as of the May to June 2023 reverse head and shoulders bottom, acting as a pretty reasonable support. And now as an additional resistance, though I suspect in the background the September 2021 low at 181.70, and perhaps more importantly the 50% absolute Fibonacci line at 180.5 had helped in the past to prop up prices, and now this year to cap prices instead. In a bigger picture, last time I spoke there has been no significant pattern development being undertaken, apart from the previously mentioned neckline. This was a little disappointing and unsurprising, all at the same time. The market seemed reasonably happy to travel sideways to ever so slightly higher, around, along and on top of the neckline, towards the greater bearish pressure of the declining long moving average, currently 186.35, coming in from above. This situation was not designed to last, and we have this week seen the start of a possible small new pattern. We are set up this week for a possible weekly key reversal. Thus, if we close tonight either over 178.40 or under 174.95, then we'll be on. However, it very much looks like we may see the lesser outside week pattern here instead of a weekly key reversal right now.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.